In this lecture, I am trying to cover the breakup of an option premium. When you buy an option, you pay some price, which is called the option premium. When you sell an option, you get some price. So the buyer of an option has to pay option premium. The seller of an option collects option premium. So when the chain of option is published in the website of any exchange, for example, in this case, the National Stock Exchange of India, it not only gives the option premium, it also tries to give the breakup of the intrinsic value and extrinsic value of option. Option premium has two elements, the intrinsic value and the extrinsic value. And in the extrinsic value, there are two parts, the time value of money and implied volatility. This is why I was discussing so much about volatility and implied volatility. Implied volatility is actually the core of the market. You make money or lose money if you cannot play properly with the implied volatility. Now let us go to a real life market situation. This is the market situation picked up from NSE website. The date of this is Friday, March 5, 2021. You will see here the next trading day is 8th March 2021. This is because Saturday and Sunday are holidays. So, in this data that has been published by NSE, NSE actually published a long list of option contracts called option chain. I have taken the prices which are close to the money, that is near the money. Now, where is the money? Money is here, 14,938.10, which is called the underlying price, 14,938.10, the published figure. So this is the underlying price. Based on this underlying price, on the close of the day of market on Friday, March 5, 2021, these were the data. In this LTP, basically the option premium. Here is one column for the calls and here is another column for the puts. Now what is the breakup of this? Let us see. This side I have taken the call and this side it is the put. Now in the calls, the prices are 209, 184.95, 156.45 and 135. I have put it over here. Similarly on the put side, I have taken these prices and put it over here. Then I have put the strike prices. Strike prices are common, 14,900, 14,950 and 15,050. These are all here and similarly these are also here. In the call side, strike price lower than the underlying are in the money. That means there is some intrinsic value left in it. And in the put side, the strike prices higher than the underlying are in the money. So here out of these four, only one is lower than the underlying, 149.38 and here it is 14900. All other cases, the strike price is higher than the underlying price. In this case, that is in puts, underlying as usual is here. So, strike prices higher than the underlying are these 14,950, 15,000 and 1550. So, here there is an intrinsic value, 14938.10 is deducted from 14950 and you get the intrinsic value. So here in these three contracts we have intrinsic value, in this there is nothing, and just the reverse of it on the call side, here only you have intrinsic value and rest of the thing you have nothing. So from the total value, if you take out the intrinsic value, what you get is the extrinsic value. So extrinsic value in these contracts are listed over here. So 135.0 is 135. 209 minus 38.10 is 170.90. Similarly over here, the total value are all here. These are picked up from here. And from this I have deducted the intrinsic value. That means strike prices which are higher than the underlying. That intrinsic value I have deducted. And rest is with the extrinsic value. Extrinsic value has two parts, as already discussed. One is the time value of money and one is the value driven by implied volatility. Now, how the time value of money is calculated? NSE itself has declared that 10% interest rate is applied while computing the implied volatility. It basically means it is calculating the time value of money, applying interest rate of 10% per annum. So these are weekly options. So 6 more days are left for expiry of the option. So 6 days, 10% interest rate per annum and calculated for 6 days. More or less, the calculation could be a little more complicated, but more or less it could be in the range of 3 rupees or so. So if you take out the time value of money, that means 3 rupees or so from the extrinsic value, rest of the price is only for implied volatility. Now, why people will pay this extra price for implied volatility? Because if you take out the intrinsic value, you take out the time value of money, then rest is the price driven by implied volatility. Why would people pay so much? That is the gap over here minus the time value of money for implied volatility. The reason is both greed and fear. People who have existing assets, existing investments in Nifty 50 stocks, they could be fearful that the price will come down and they will lose money on their portfolio. That's why they would try to protect it and use the option market to protect it. And there could be another set of person who do not have any real assets in terms of Nifty 50 shares, but they want to play on the volatility of the market. That is the movement of the underlying price and make profit out of it. So this is why extra price is paid for the implied volatility. As the time decays, the price will also decay, because the risk will also decay, in the sense that here you have the elements built up for 6 days, then on Monday morning it will be another 4 days left. But if the underlying changes, underlying 14,938, that is also moving, and if the underlying changes, then these prices can again change. So that is more or less the breakup of option prices or option premium. Thanks for your attention.